This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos about losing because of mistakes. One of the common reasons that beginners lose is because of psychology and false beliefs. Most of the money that beginners lose is because they have incorrect beliefs about the market. They try to apply logic that works outside of trading into the trading world, and they discover that it doesn't work. That if you do what everybody else is doing, you're probably doing the wrong thing. I want to talk about common mistakes that beginners make and how to avoid them or how to fix them. Every trader, no matter how good, is going to lose money sometimes because good trades go bad. There's no 100% certain trade. I'm going to talk about those in the videos on losing when a good trade goes bad. That series of videos is shorter because traders lose much more money from mistakes than they do from good trades going bad. Beginners are ignorant. By ignorant, I don't mean a low IQ. For example, I'm ignorant of lots of things around the world, especially cultural things in countries where I have not visited. Ignorant simply means a lack of information. However, ignorance as a trader is a problem, but it's easy to fix by simply spending time and being open to ideas that you would not have otherwise considered. Common ignorant beliefs that lead to beginners losing money: perfect trades. Beginners always believe there's some kind of a perfect setup, and they get mad at me for not telling them my perfect setup. Perfect trades cannot exist. Every trade is a combination of risk, reward, and probability, and a perfect trade has great profit, great probability, and very little risk. That cannot exist. If a trade has really good risk reward, it has low probability. If a trade has very high probability, it has very bad risk reward, usually very low profit, a scalper. Another thing that you sometimes hear is noise. And noise is a terrible term. It implies that the market is behaving randomly. The market never behaves randomly. It may be making moves that are too small for you to trade, but somebody's trading them. For example, right here, you might not want to trade, but there are lots of computers trading, some for 1 or 2 tick or 1 or 2 pip scalps, but they're trading. High-frequency trading firms are trading, and other institutions are simply trading because they've determined that this is a good price where they should be selling. Just because the market is making moves that look too small for you to make money does not mean that they are random. Everything that happens for a reason. Another common false belief that beginners have is that either the bulls are making money or the bears are making money. Well, 90% of the time, both the bulls and the bears can make money if they use wide stops, scale in, and manage their trade appropriately. One of the problems that beginners often have is their focus on risk, and they ignore probability and reward, and that results in them sometimes picking bad entries. Beginners often have small accounts, and because they have small accounts, they don't want to lose their money. They equate losing the money in that account as the death of their dream of being a profitable trader, and therefore they're desperate to not lose that money. Also, their spouses will get mad at them if they lose money. There's therefore a lot of pressure on them to focus on risk. And unfortunately, the result is all they see is risk. And to trade profitably, you also have to consider probability and reward, and not simply risk. If you only look at one variable, you're probably going to lose money because you need the other 2 variables as well. For example, let's say a beginner sells here thinking that, oh, it's a pair of big bars. It shouldn't be doing that. We're reversing up and down, up and down, up and down. This should reverse down. I'm going to sell this, betting that it's a buy climax and it's going to reverse. If he took that short, at some point in the next bar or 2, he's going to decide that, well, maybe he bought a breakout that's going to succeed. However, a lot of times beginners will hold on to the trade hoping that this is the exception. He knows at this point or this point the probability is we're going higher, but he'll hold knowing that nothing is 100%, and that means he has a real probability that the market will eventually go his way. He knows the probability is small, but it exists, it's real, and therefore he'll ignore the reality that's in front of him, that he took a bad trade and he needs to get out, but he's hoping that the market will go his way. That's one of the other problems that beginners have. It's natural that people are hopeful. If you think about it, it's genetically bred into all of us to be hopeful. Thousands of years ago, if you did not have food in front of you and you were not hopeful that you could find a deer to shoot and feed your family, you'd just sit around and you would eventually go extinct. Whereas another person who was out there aggressively looking for food, confident and hoping that he'd find the food, and he keeps persisting, he's going to survive. So being hopeful is a survival skill. However, it's horrible as a trader. You cannot make money hoping. You have to objectively evaluate what's going on. And if you fall back on your natural tendency to be hopeful, you will lose money. Buying here and watching the market go up, hoping that it will reverse, that is the wrong thing to do. Let's say a beginner buys here. He sees a bull trend, a pullback, a breakout of this bull flag, and a pullback from the breakout. A good-looking buy signal bar, a reasonable buy. However, he's only thinking about risk. He doesn't want to take a chance of losing any money, and therefore he uses a tight stop right below the buy signal bar right here. That is wrong. If you're taking this trade, there's only one appropriate stop, and that's down below the bottom of the original leg up. This is the major higher low. This is a minor higher low. The market could easily fall below this low in a two-legged pullback, one pullback two, and it did, and simply become a high two bull flag. Two legs down, one pullback two, and the bull trend resumed. You cannot use a tight stop like that. The beginner took the good trade, bought above the bull bar, but used a bad stop, and he got stopped out. It's a small loss, but if you do it 2 or 3 times in the course of a day, you're going to end up losing a lot of money. Another problem that beginners often have is they'll take a trade as a swing, but manage it as a scalp. The problem with that is if you're taking a swing trade, the probability of success, the probability of making a profitable swing, is usually only about 40%. We have a very strong rally here. Traders buying for any reason and using the appropriate stop have maybe a 50 to 60% chance of making a profit. If a trader buys above this bull bar, he has to use the appropriate stop to get that 50 to 60% probability of success. This is a major high or low, a strong breakout to a new high. We have breakouts above minor highs here, but not strong breakouts lasting many bars, and therefore this is a minor high or low, and the market could fall below it and still be in a strong bull trend. A beginner who took this buy above this bull bar and used this stop initially might become upset by the bad follow-through here and decide that he doesn't want to risk the appropriate amount, and he uses a tighter stop, maybe below the bottom of the buy signal bar, and gets out here. He ends up losing on a good trade simply because he did not use the appropriate stop. He decided to convert it into a scalp. But for a scalp, you probably need 70 or 80% probability of success. And this is not a 70 to 80% buy using that stop. The probability of making money, buying above this bull bar, getting filled here, and putting a stop below here, I would say it's 50-50. And therefore, if you tighten your stop there, you're going to lose money. What happens sometimes is the beginner takes the trade, and then let's say this is a 5-minute chart. He has 5 minutes, 10 minutes to think about it, and he begins to wonder, what if it goes against me? It could go all the way back down here, and I don't want to risk that much. Well, if he is unwilling to risk this much, he cannot take that trade, because this is where the appropriate stop goes. If he's entering as a swing, he has to be using the appropriate stop, and he only gets out if his stop is hit or if the market clearly becomes bearish, which it did not. The opposite is another common problem that beginners have. They take a trade as a scalp, and then they manage it as a swing trade, which means far too much risk for too little profit. Also, beginners should not be scalping, because to scalp profitably, you have to be able to win 70 or 80% of the time, and beginners simply cannot do that. The bulls have a breakout, and the market went higher, another breakout, a pullback. And let's say a beginner buys this close, hoping that it's the start of another leg up. Maybe he bought it even though he knows it might be a double top and a wedge, 1, 2, 3. And then the next bar is a bear reversal bar. The beginner who bought that close and sees this bar is now probably going to be upset. Let's say initially he was planning on putting a stop right below his buy signal bar, which is right here. And he was surprised by this bear bar, and now he's frozen, he's paralyzed, and he's thinking that, well, if I take the loss and get out where my stop is hit, then I'll lose money. He knows that if he's scalping, he has to win most of the time, and therefore he's afraid to take losses. So instead of exiting where he should exit, he'll use a wide stop and try to convert his scalp into a swing trade. But then he will not manage the swing trade correctly, and he'll end up losing much more than he expected. When he bought that bull close, he knew the probability was not high, but he was hoping that the momentum up would lead to a profitable trade. And he was shocked to see that bear reversal bar, and once he saw it, he looked to the left and said, uh-oh, maybe it's a double top, maybe it's a wedge top, maybe I took a bad trade. He decides that, well, swing traders usually can make money if they use wide stops and scale in, and therefore I'll use a wider stop. Maybe I'll put it below the bottom of the most recent bull leg. Even though this is really a minor higher low, the breakout does not have enough bars, did not go up high enough, and therefore it could simply be a bull leg in a tight trading range. The market could fall below it, and the market could still remain always in long. The most recent major higher low is at this point. If a trader takes that buy on that close, he has to be using a stop down here. And he eventually finds himself stopped out at the bottom of the most recent bull leg. He ends up exiting with a loss that's 4 times bigger than the minimum scalp he was hoping to get when he bought that close. If you're losing 4 times bigger than what you're winning, you have to be right 80% of the time to break even. You probably have to be right better than 90% of the time to have a profitable strategy. And that's simply unrealistic. Very few really good traders win 90% of the time, day in, day out, every day of the year. For a beginner to expect that, it's just not going to happen. And therefore his strategy is wrong. It's a losing strategy. If a beginner takes a trade as a scalp, he has to manage it as a scalp. This is a bad trade. It became clear when the bears had that reversal bar. The beginner should simply get out either below that bear bar or below the buy signal bar and take the loss. In fact, anytime a trader takes a trade and decides the trade is not good, he should get out immediately. And therefore, a beginner who bought this bull close could get out at the close of this bear bar without waiting for the market to trade below the low of that bear bar. He had to know at the close of that bear bar that this was not a high probability bet that he'll make money. A more experienced trader would have realized that this was probably a buy vacuum test of that close. The bulls had a reasonably good bull trend here. Some are buying closes all the way up. Some became disappointed here, held long, betting that the sell-off would be a leg in a trading range and will get back up to that close. So they'll buy more lower. Those bulls who bought used a wide stop and scaled in lower are hoping the market will get back to their high close where they could sell. And that's what exactly happened here. Buy the close bulls, bought more lower, and when it got back to their high close, their last entry price, they sold. And therefore, this rally was probably a buy vacuum test of resistance at the high close and the high of the day, and not the start of a new buy the close rally. Bulls were selling here. The bulls who bought here are relieved to be able to get out break even, and now you have bulls selling. That's not a good location for you to be buying. And it's also the third push up. 1, pullback 2, pullback 3, and the pushes up are getting smaller. So it's a wedge top. Again, a bad location to be buying. If you look at a chart and you have 100 bars on the screen, only about 10% of them are in a very strong breakout, up or down. Here we have a reasonably strong breakout. It's about 10% of the bars on the screen. And when you have a very strong breakout, you have 60, 70, sometimes 80% chance of getting a measured move up based upon the bars in the breakout. For example, the open of the first bar to the close of the final strong bar in the breakout, probably 70% chance the market's going to go up for a measured move. And you can see what happened when it got to that measured move target. The market stalled, in part because bulls were taking partial profits. You can buy the close of any of these bars and take partial or full profits at the measured move target. 70% chance it's going to get there. We have a close on the high, well above the neckline of this double bottom, and we have a follow-through bar closing with a bull close as well. 70% chance we're going up for at least a second leg, probably at least a measured move based upon the height of the strong part of the breakout. Reasonable to take profits, partial profits, full profits, at a measured move target based upon the height of that breakout. The actual risk was small. If you bought that close, the actual risk is 1 or 2 ticks or 1 or 2 pips, but very, very small. High probability, you can exit at simply 1 times actual risk if your profit is at least as big as a minimum scalp. Here, if the actual risk is only 2 ticks or 2 pips, 1 times actual risk is 1 tick or 1 pip, 1 or 2, and that is not as big as a minimum scalp. So if you're trading the E-mini, you have to hold for at least 4 ticks, 1 point, a minimum scalp. And if you're trading the Forex markets, you have to hold for at least 10 pips, a minimum scalp. However, if this measured move target is 2 to 3 times a minimum scalp, it's reasonable to hold for 2 to 3 times the size of a minimum scalp. I said that 10% of the bars on any chart are in a strong breakout. That means there's a high probability of some kind of a measured move in the direction of the breakout, here, up. It also means that it's very difficult to make money selling when the market's in a strong breakout. If you sold this high, very difficult to make money. If you use a wide stop and scale in higher, you can avoid a loss, but very difficult to make money selling here and holding short as it's going up. Some bears who sold here would be disappointed by the extent of the rally. They'll sell more below a strong bear bar that is at least 2 to 3 times the size of a scalp higher, and then they'll either hold, hoping the market gets back to their original entry price, getting out break even on their first sell and with a profit on their second sell, or they might decide that 30 or 40 bars up is so extreme, maybe it's better simply to get out between the two entry prices and get out break even on the trade. Small loss here, small profit here. They sold this high. If they held through all of this, they could sell more below this bear bar, get filled here, and this is their average entry price. If they exit here, they lost money on their first sell, they made money on their second sell, and they get out break even on their entire position. Or they could hold, hoping it gets down here. If it makes a couple reversals up with bull bars just above their target, they would get out on the reversal up, which would be around break even on the entire trade. And never fell below the first entry price. They therefore could not get out break even on their first entry. And they should just get out on a reversal up late in the day, late in the session. Can a beginner take that sell and sell more higher? Not realistic. And that's one of the problems that beginners have. They have the right idea, they know what they need to do to avoid a loss or to make money, but they don't have the ability to do it. In this case, can a beginner hold on to a short through a rally that lasts 30 or 40 bars? And is his account big enough so that he can sell more here? Probably not. It makes more sense for the beginner to get out of his short on the close of the second or third or fourth bull bar and then buy the bull flags in a bull trend. And he would more than make up for the small loss that he originally took. One of the main reasons why beginners lose money is because they don't know how to manage trades properly. To manage trades properly, you have to make decisions about the position size, the risk, where your stop is, and the reward, where to take profits. And if you make a mistake with any of those three things, you're probably going to lose money. I said only 10% of the bars on any chart are in a strong breakout. In other words, high probability of making money, betting the trend will continue. 90% of the bars on any chart are either in a bull channel, a bear channel, or a trading range. Here we have all three. Every trading range has a leg up and a leg down. Here we have a bull channel and a bear channel and a trading range. This is typical. 90% of the bars are either in a bull channel, a bear channel, or a trading range. When that's the case, buying or selling at any instant within the range, you have between a 40 and 60% chance of making a profit, 40 to 60% chance that the market will soon go against you. On every bar on the chart, if you buy, you have between a 40 and 60% chance of making a profit. If you sell, there's between a 40 and 60% chance of making a loss. You do not have a 70% trade when the market's in a trading range. From the trader's equation, you know that this is all you need to make money. As long as you have at least a 40% chance of making money, and you do buying and selling at any point in a channel or in a trading range, as long as you have at least a 40% chance of making money, you have a winning strategy if you exit with at least 2 times your actual risk. Beginners lose money mostly because of psychology and false beliefs. For example, they believe perfect trades exist. They also believe that the market often moves randomly with no rational trading going on behind it. And they also believe that low probability events can save them when they make bad decisions. They cannot. Once you see that you're wrong, you should get out. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on losing because of mistakes. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on losing because of mistakes. I'm going to focus on bad management in this particular video, which is a major cause of losing money. From the trader's equation, traders know that even if you only have a 40% probability of achieving your goal, it's a profitable strategy if you exit with a reward 2 times your risk. Reward twice risk, even with a probability of only 40%, is a profitable strategy. Since only 10% of the bars on any chart are in a strong breakout, 90% of them are not. 90% of the bars are either in a bull channel or a bear channel or a trading range. And during these bars, 90% of the bars on the chart, bulls and bears can make money by managing trades correctly, because the probability is between 40 and 60% for any time in here for bulls or bears. Selling at the low, selling at the high, buying at the high, buying at the low. If you can manage your trade correctly, for example, scaling in using appropriate stops, you can make money. The reason why most traders lose money is because they do not manage their trades well. A lot of times they'll come in with a plan to do something, and they honestly believe they're going to execute their plan, but when it comes time to make a decision, they don't do it. They don't have the emotional ability to do what they know is right, and the result is they lose money. 90% of the time, if you manage your trade well, you can get out without a loss or with only a small loss, or you make money. If you manage your trade well, you can save even a bad trade. You can buy at the top of a trading range, sell at the bottom of the trading range, and if you manage properly, you can either avoid a loss or make money. Again, that's during 90% of the bars. If you're selling in a strong breakout, you're probably going to lose money because there's a 70% chance the market's going higher. Whereas in here, there's only a 60% chance that the market is going higher after a rally, and only a 60% chance it's going to go lower at most. The probabilities for the most part are between 40 and 60%. For example, let's say you sold below the neckline of this double top. We have a double top, here's the neckline. If you sell with a stop just below this low, you'd get filled right here. If you use a wide stop, maybe a measured move up based upon the height of this first leg up, and then waited for a bear bar and sold more below the low of that bear bar, and then from there used a fairly wide stop, you should be able to make money or at least avoid a loss. Traders who sold here, sell more with a stop here, are hoping that the market comes back to their entry price at this low so they can get out, break even on their first sell and with a profit on their second sell. You want the second sell to be at least 2 to 3 times the size of a minimum scalp above the first entry so that if it comes down to your target, you'll make 2 to 3 times the size of a minimum scalp. Here, the market got down to the target late in the session, did not fill it, had to go one tick below that low for you to get out break even on this sell. It reversed up again a second time. You're getting late in the session, reasonable to get out. And if you did that, you would have lost a small amount on your first sell, and you would have made a bigger amount on your second sell, and you would have made a small net profit, even though you were selling at the bottom of a bull flag in a bull trend. If you're a beginner, would you have done that? Of course not. You probably would have sold the reversal, even though it's a bull trend. However, you probably would have gotten out maybe here. This is a give up bar, a sign that the weak bears are giving up, and you would never have been able to add to your position. Also, your account size is probably too small, and you probably are trading too large of a position to add on here and use the appropriate stop. So your intention was good, thinking that I'll sell here. If it goes higher, I'll sell more. But when it actually goes higher, emotionally, you're scared of losing too much money, and you get out here instead of managing your trade appropriately. You had an unrealistic goal for where you were emotionally as a trader and for the size of your account. And you probably were trading too big of a position to allow you to execute that goal. You cared too much. You were thinking too much about losing money. And the result was you could not manage the trade properly. We're in a bull trend, and let's say you bought here. You got a small bull flag, and you put your stop appropriately below the most recent major high or low. Here you are buying what turned out to be just about the high of the day. If you manage your trade correctly, 90% chance you'll either make a little money or you'll avoid a loss. The market sold off for a couple legs, 1, pullback 2, and you have a bull bar closing on its high. You're pulling back to the moving average. Traders can buy more on a stop above that bull bar as long as this is at least 2 to 3 times the size of a scalp below the first entry. In a strong bull trend like this, a lot of traders will buy even if it's only 1 times the size of a minimum scalp. So let's say this is a Forex market. A trader will buy as long as this is 10 pips below his first entry. If it's the E-mini, he'll buy as long as it's 1 point below his first entry. He's disappointed by the extent of the sell-off, and now he's thinking that maybe it's a trading range instead of a bull trend. If it's a trading range, he does not want to be buying high, so he's looking to exit on his first entry, break even, and he'll get out with a scalp on his second entry. He avoided a loss. In fact, he made a small profit, even buying at the high of what became a trading range. It sounds easy to do, but these things are things that beginners simply cannot do. Over time, you can do it. You don't get emotional about the market going against you. You know, as long as it stays above this low, it's either a bull trend and you'll make a quick profit, or it'll be a trading range and you'll be able to avoid a loss. That sounds good, but it's very difficult for a beginner to do. He knows it's the right thing to do, but he's thinking so much about money that he cannot do it. If you cannot manage a trade correctly, you cannot take the trade. You cannot buy here, put a stop below here, and then plan to add on here if you're going to be afraid, if it's too much money. If you cannot take the trade and manage it properly, simply wait for a trade that you can manage properly. Experts also lose money by taking bad trades. However, they don't take bad trades very often, and they usually get out pretty quickly as soon as they decide it's a bad trade. Some trades are simply very difficult to structure profitably. It's very difficult to structure a profitable trader's equation. One is selling in a strong bull breakout. That's a mistake. Another is buying in a tight trading range, especially with a stop order. If you do something and you, within the next minute, decide you made a mistake, or at any time you decide you made a mistake, it's usually better just to get out and take the loss. And that's part of trade management, and that's what expert traders do. They manage their trades well, so when they get a loss, the loss is not too big. Let's say you see a micro double top. The market went up and then down and then up again, and we're breaking below the micro double top. You can call it a double bottom. We're breaking below the double bottom. And you have a very big bear bar. And let's say you're an experienced trader and you sold this close. Most traders would not do that. They would wait for one more bear close, which did not happen. We have a bull close on this bar. You never got the bear close. If you decided once you took this sell and then you saw this bull close that, oops, you made a mistake, you simply get out. You can get out on the close of this bar or above its high. Look at the open of this bar and the close of this bar. What do you know? The open of this bar is above the close of this bar. And that tells you that a lot of the bears who sold here did not like the bull close. And as soon as they saw this bar close with a bull body, they hit buy the market to get out as soon as they saw this bull close. And there were so many traders buying the close of this bull bar, the open of this bar was above the close of this bar. That's a warning that a lot of traders were buying. A lot of them were bears deciding it was a bad trade. And here's where the final bears gave up. The bears who sold that close or sold below this double bottom are disappointed by the follow-through bar. They wanted immediate follow-through. Look at the bulls who bought this close or that close. They have follow-through, and that increased the chances that they would get higher prices. Here, you have a bear breakout, but a reversal bar, a bull bar for the follow-through. Bad follow-through makes it unlikely that it's going to go much lower. If you sold that close and you were disappointed by this bull bar, you might place a limit order to get out break even. To get out, you need the market to trade back below that close. And look at the low of this bar. It did not get below that bear close, and therefore, if you had an order to get out break even, you would not have been filled. Some traders instead would place the order to get out just a little bit above that close, thinking that there may be so many traders trying to buy that close, it may not get to that close. It has to go below this close to get filled. Those traders were able to get out. The ones who tried to get out with zero loss, who tried to get out with a limit order at this close, were trapped. And you can see what happened. They bought back their shorts here. They were giving up. The bulls saw that the bears were trapped, and they were ready to buy as well. An experienced trader, if he could not get out, he's going to get out maybe at the close of this bar or on the stop above that bull bar, and he'll get out here with a small loss. And that will allow him to start doing the right thing and buy and make a lot more profit than what he lost when he managed his trade correctly by getting out quickly. He took a bad entry. If he gets out quickly, he's fine. He can take buys and more than make up for the loss. For example, he could wait for two big bull bars closing on their highs. Now there's a high probability the market's going up for at least a measured move based upon the open of this bar to the close of that bar. Maybe 70% chance will go up. A reasonable buy the close situation or buy the close of any of these bars. Even this bear bar, the odds are, after this much of a reversal, we're going at least a little higher. We have a double bottom. We went up. We're trying to go up again. Can you buy above this bar? Hoping for a double bottom. It's also a high 2, high 1, pull back, high 2. We have a reversal bar. The close of this bar is above the middle, so it's a reversal bar, but it has a bear body. It's also following a lot of bars without a bull body, and is following a big bear breakout. This is a big bear breakout bar and a follow-through bar. The odds are we're going at least a little lower. This is a bad buy. If you take this as a high 2 and a double bottom, it's a low probability bet after this many bars without a bull body. The trader's equation is bad. The probability of making money is probably 30% or less. This is a strong enough breakout to have a 70% chance of at least lower prices. You're taking a buy that is probably a minor reversal, a very tight bear channel, unlikely to lead to a major reversal, and therefore a minor reversal means profit potential is small. You're taking a low probability buy with very little reward and relatively big risk compared to the reward. So bad risk reward and bad probability, that tells you this is a bad buy. In fact, there probably are more sellers at the high of this bar than there are buyers. Beginners do this all the time. All they see is a high 2 and a double bottom. They're eager to trade. They take the buy. Beginners take a lot of bad trades, trades where the trader's equation is bad. And it's usually better to do the exact opposite. Expert traders see this breakout and this reversal down, and they're eager to sell. When they see this bear bar, they know the odds of a reversal up are small. They're selling with a limit order above the high of this bear bar or with a stop below the low of this bear bar, expecting a trend down. In this particular case, the probability and the risk reward are bad, and therefore taking this bet is the wrong thing to do. You should be doing the exact opposite. It's a bad trade, but beginners do that all the time. Whenever you take any trade, if the probability is especially low or the risk reward is especially bad, it's very difficult to make money. Beginners tend to focus only on risk because they're afraid of losing their account, which would mean the death of their dream as a trader. So they focus on risk. They therefore like to take trades that have very low risk. If they're taking a trade with very low risk, they tend to go for quick profits as well. As soon as they get any profit, they're happy. And that means they tend to scalp. However, you're going for a small reward relative to risk. So let's say your reward is only 1 times your risk. Even if you win 60% of the time, you're going to lose money. If you're going for a reward where the risk is slightly greater than your reward, you have to win 70 or 80% of the time to break even, and close to 90% of the time to consistently make money. That's just not going to happen if you're a beginner. If you're a beginner, you'll be happy to win 40% of the time. And this is a mistake that beginners make all the time. They just focus on risk and they want small profit. Any profit will make them happy. By doing that, it's a horrible trader's equation and they're going to lose money. Yes, they will not lose much money on any one trade, but if you do it 3 or 4 times a day, you start to lose money pretty quickly. It adds up to a lot. Whenever the risk on any trade is greater than the reward, 60% probability is just not enough to have a good trader's equation. You have to be winning 70, 80, 90% of the time. And you have to manage all those trades very, very well. And that's simply impossible for a person starting out. Therefore, beginners should not scalp. Think about this. If you have a low risk trade, then you have a very good risk reward situation. Low risk means good risk reward. However, there always has to be a reason for an institution to take the opposite side of your trade. If you have fantastic risk reward, that institution has fantastic probability. In other words, he has a high probability of winning if you have great risk reward. If he has a high probability of winning, you have a low probability of winning. That means you're probably going to lose. If you're buying in a tight bear channel with no bull bars, it's a very low probability trade and it's a line of reversal, which means it's either a bear flag or it's part of a trading range. Your reward is going to be low. Therefore, if you're looking to trade, you can only look to sell. You cannot be looking to buy when the trade you're considering has low reward, in other words, bad risk reward, and low probability. It's better to do the opposite. It's a bad trade. You have a reversal bar, but it's a bear body and it's following a big bear bar. You have 8 bars without a bull body, so there's no buying pressure. You have a tight bear channel, so the only reversal you'll get is minor, which means a small reward. And that bear body, even though it's a reversal bar, it's a bear body after a bear breakout. And therefore, it confirms the breakout, and it means there's a 70% chance we're going at least a little bit lower. And you're buying. You cannot do that. An experienced trader will do the opposite. He'll say, wow, that's a good breakout, a bear body for follow through, decent follow through, it should go down. I'm going to sell with a limit order above the high of that bar. And that's exactly where you're looking to buy. The expert trader is doing the opposite. In addition to taking bad trades, beginners manage their trades badly. For example, he'll buy here and he'll think, if I scale in and buy more lower, I increase my probability of success. And that is true, but you also increase your risk. And you're buying in a very tight bear channel, probably a small pullback bear trend. The chance of making money buying for any reason, even if you add on, is horrible. The beginner buys here, he hears somebody on television say buy, 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 that you buy more lower, terrible idea. He buys more here, his position size is too big, he cannot handle the appropriate stop that would allow him to sit through the sell-off and get out break even on the reversal, and he ends up losing a lot more money than he should ever lose. Scaling into a trade makes sense if the trade is good to start with, and if you can manage correctly. For example, use a wide stop and scale in appropriately. It's a disastrous idea if you cannot use a wide enough stop, if you cannot take the appropriate additional positions, if you cannot add on at the right time, if you do add on at the wrong time, and if you're taking a bad trade, if you're buying in a very strong bear trend, a small pullback bear trend. The beginner who buys here, buys more here, thinking he's trading like a professional. Eventually he gives up and takes a loss here. The loss on the combined position is far greater than he ever wants to take on any trade. His account is too small to add on, his stop is too far for a double position size, and he ends up losing 4 or 5 times more than his average win. That means he has to win 5 trades over the next week or so to make up for this one mistake. A terrible thing, but beginners do that regularly. Another mistake that beginners often make is they see the trend, they know it's going down, and they want to get short. What they'll often do is wait for a very strong bar, a very big trend bar, believing that the momentum will result in follow through and he can make money. In other words, he's entering late in a trend once the trend has become climactic. Here's the open of the session. We've got a couple big tails on the bottoms of the bars, a bull bar closing on its high, a small bar, and now a big bar. The market looks like it's accelerating up. Let's say the beginner buys this close, hoping for a buy the close rally, which it could be. It's reasonable to do. However, he'd have to be disappointed by this bear bar, and he has to understand what took place right here. If he does not understand, he's in big trouble. Bulls have bought this close, disappointed by this bear bar, try to get out break even, placed a limit order to get out at that close, or they placed a limit order a little bit below it. And you can see what happened when this bar got near that close. It sold off. And this is caused by a lot of bulls deciding this was a bad buy. This bar tried again to get above that close. It could not even get above this high. That shows you that the bulls who did not get out here lowered their limit order to take an even bigger loss, and a lot of them did not get filled here. The market's going down, and ultimately the bulls give up. Alternatively, a trader who watched the small pullback bear trend and then get the wedge bear flag, 3 pushes up, 1, pause, 2, pause, 3, and he's got a sell-off here, and now the market is accelerating downward. He thinks it's going to be a new, stronger leg down. He doesn't realize that this could be the final bear flag, and this could be a climactic end of the trend. So he waits the entire time, doesn't take any of the trades that were there, and now when the market's starting to accelerate down, he's finally deciding that he's going to sell. He has to be disappointed by the bull bar and then several bull bars. An experienced trader who took that sell would say, that's not good. I better try to get out break even. I'm going to place a limit order to buy back at my original price, and he gets filled here. The beginner does not. He ends up getting out here or up here. He was waiting to sell, and he ends up selling way too late in the trend when it's at a sell climax. He was waiting to buy. He bought too late at a buy climax. Selling down here, what do you think about the trader's equation? The stop is up here, so now the risk is great. Probably not much profit left in this leg. And the probability after a climactic breakout late in a trend after a possible final flag, the probability is not all that high either. The math is actually better to bet on the opposite. You're taking a low probability sell where the risk is big and the reward is small. It makes more sense to be doing the opposite. As a beginner, you cannot do the opposite, but an experienced trader might do that. He might place with a limit order to buy at that close, get filled here, or buy on the reversal up, or at this point, a potential high or low major trend reversal. Bear trend, double bottom, reasonable buying pressure on this minor reversal. Maybe the next reversal will be major, so the bull would buy above that bar. Beginners want low risk, and they also want very high probability, and they equate momentum with probability. Bull bars, good momentum, maybe high probability. It can be high probability. Bear bars, good momentum, maybe high probability. It can be, but not this late in the trend. It's high probability here and maybe here, but when you get this much strength late in a trend, 20 or more bars into the trend, it's more likely an exhaustive end of the trend, and the trend is probably transitioning to a trading range. Beginners, all they see is this bar. They just only see the bar that just closed and maybe the bar in front of it. And they'll say, wow, bear trend, two big bear bars, it has to go down. He's not thinking about that it could be a climactic end of the trend. All he's looking at is these two bars. He's not looking at this. And he has to look at everything. He's thinking, well, the institutions aren't going to take my money. I have enough momentum down. Surely they'll give me at least a little bit of money. They don't care. They don't even know you exist. They don't care that you exist. You don't have enough money for them to take. They're not going to waste their time taking money from you. Goldman Sachs wants to take money from Morgan Stanley or from Bank of America or from some Japanese bank. Your money is just too small, so nobody cares about what you're doing. And they certainly don't care about helping you. Nobody cares. You're invisible when you trade, and that's how you should think about it. Nobody knows what you're doing. Nobody cares what you're doing. Nobody's trying to take your money, and nobody's trying to help you. Another mistake that the beginners do is, instead of a mistake of commission, doing something bad, it's a mistake of omission, not doing what he needs to do. Let's say this beginner buys the high two, 1, 2, and a double bottom. He knows the probability is low. He's got 8 bear bars, and he's got a bear sell signal bar, and no bull bar for 8 bars, and an obvious bear trend. We have a micro double top. We went up on this bar, down, and up on this bar, and we have a bear bar closing on its low. He knows he should get out below this bear bar or below this bull bar for the micro double top. He knows that's the right thing to do, but he does not exit. He does not want to take the loss because he doesn't want to feel like a loser. He wants to win a high percentage of the time, and he's taking a chance. Well, maybe it'll go down a little bit and then come my way, and maybe I can get out break even. He knows that's the wrong thing to do, but he just can't do it. He cannot take the loss. He doesn't put a stop in the market. He keeps the stop in his head, so he does not have a stop down here. Stops are to protect you against you. They're not to protect you against the market. And a lot of times the beginner will decide, well, maybe this time I'll cancel my stop and just try to work my way out of the trade the way experts do. That's not what experts do. When they do something stupid, they take the loss. Sometimes a beginner will take a great trade and lose money because he manages it badly. For example, we have a bear breakout, good follow through, 8 consecutive bear bars. It's reasonable to sell the close, expecting at least a small second leg down and maybe a spike pullback channel down. He knows the appropriate stop is either above the top of this bear leg or above the top of the entire bear trend. If he's taking this trade, he's selling low in a bear trend. He has to use a wide stop because one of two things will happen. Either the market will go down and he'll make money, or the market will go up and it'll be a trading range. And if he manages his trade well, he'll avoid a loss because he knows the market will come back and let him out break even. The stop is wide. If it's, let's say, 3 times bigger than what he usually uses, he has to trade 1/3 his normal position size. If he cannot reduce his position size, he cannot take the trade. He just has to wait for a trade that he can trade. The beginners tend to think about risk, and they know the stop is much further away than what they typically use, and therefore he's afraid. He ignores the other parts of the trader's equation, reward and probability. The probability is high that he's going to make money, probably some kind of a measured move down. That means the probability is high that he'll probably make a lot of money, but it requires him to use the appropriate stop. One thing a beginner can do is take the trade, use the appropriate stop, and then go for a walk and come back in a half hour or an hour and see what the market is doing. And if he does that, he'll discover that it's actually a pretty profitable strategy. You always have to use a reasonable stop, and that means a stop that's not too tight. And you have to trade small enough so that if your stop is hit, your loss is no bigger than on any other trade. Beginners get so anxious when they're in a trade that they're looking for any reason to get out. It's painful, emotionally painful. In this particular case, he sold his close, and now he's thinking, uh-oh, maybe it's a high 2 buy, maybe it's a double bottom, we have a bull bar closing on its high, maybe this is a reversal up. And he ends up buying back his short above the high of this bear bar, exactly where strong bears are selling, or above the high of this bull bar for a small loss. He's got a great short. His idea was right, but he did not manage it correctly. He could not handle losing that much money if the trade were to go against him. You cannot take the trade unless you can manage it appropriately. If the stop is too far, you cannot take the trade. Decide before you sell that the stop is too far. Don't decide after you sell. In this video, I talked about a very common cause of loss, and that's bad management. Management can come from taking bad trades. It can come from using inappropriate stops. It can come from scaling in inappropriately. It can come from trading too big a position. It can come from scaling in to too big a position with too much risk. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on losing because of mistakes. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on losing because of mistakes. I'm going to give some rules on how to avoid big losses, which is very important. One of the problems with a big loss is that it wipes out many good trades, and it takes a lot of good trades to get back to break even. It's very important to avoid big losses. On any reasonable trade, you have a 40 to 60% chance of making money and a 40 to 60% chance of losing at least a little bit of money. Great scalpers, they are rare, but they can win 90% of the time. Let's say, for example, that you see a bear trend and now you see a double top bear flag, a lower high, and you sell, which is reasonable to do. You put your stop just above the top of the bear flag. You sell on the stop below the low of this bear bar, and you get filled here. It's reasonable to get out above this bull bar because you have the possibility that this will be a profitable higher low major trend reversal. We have a bear trend, a strong enough minor reversal to break above the trend line, and now we have a pullback that has 2 or 3 legs down. 1 pullback, 2 pullback, 3. Some computers will see it as a wedge higher low. Others will see it as a high 2, high 1, and then high 2. And it's a good buy signal bar. If you're short, I think you have to get out above this bull bar. If you're flat, you can buy this looking for a swing up. Anytime there's a reasonable opposite signal, it's usually wise to get out. If you sold this double top bear flag, bear trend, and then you see a reasonable buy setup, it's better to get out. If there's then another sell setup, you can take that other sell setup. But it's better to be out of your shorts when the bulls have a reasonable buy. Anytime that you're clearly wrong, you always should exit, and don't sit there hoping that the market will go your way, or go your way at least a little bit, enough to reduce your loss. If you did not get out on a stop, now we have a reversal up with a decent bull bar, and we have a good follow-through bar after this bull breakout above this bull flag. We also have 4 consecutive bull bars, and we have 2 closes above the top of your double top. You're clearly wrong. You have to get out if you did not get out already. The single most important thing that you can do to protect against a big loss is having a protective stop in the market, not in your head. The stop protects you from yourself. Some traders will see where the stop goes and not put it there just in case it goes a little bit above the stop and then reverses back down. That is a mistake. You have to have a price on the chart that tells you that you're wrong, and you have to get out and take the loss. The single biggest problem with having a stop in your head and not in your market is that it tends to stay in your head and it never gets into the market. And the result is you watch the market go against you further and further and further, and you never exit. You end up getting a loss that's far greater than you ever should take. One big loss can wipe out the last 20 good things that you did, and it might take 20 good things over the next week or two to erase this big loss. Therefore, you cannot take a big loss like that. We have a bull trend, and we have a high one bull flag. That's reasonable to buy above this bar. Not ideal, a little bit of a parabolic buy climax, and then a bear bar and a bear buy signal bar. However, it's reasonable to take that as a pullback in a bull trend. However, let's say you held long, and then you see this bear breakout and a follow-through bar. What are you thinking about at this point? An expert, if he made the mistake of holding long through all of this, he would get out at the market or above the high of this bear bar. What would a beginner do? Well, if the beginner did not have a stop in the market, or a stop down here, or a stop anywhere, and he sees this, he might think that on television they talk about averaging in, maybe I'll average in. Averaging in other words, buying more in a losing position, is a great strategy if your premise is still valid, if it's still a bull trend. However, once it's clearly a bear trend or clearly no longer a bull trend, averaging in does not make any sense. The beginner, he might buy more here, arguing, well, it's a high 2, maybe a trading range, and he's ignoring the reality. We've had 8 or 9 bars down without a bull body. We've had a strong bear breakout, and we have a follow-through bar after the breakout bar, and it has a bear body. The odds are we're going lower. There are a lot of personality traits that all of us have that are very effective in dealing with problems in the world. And one of the things is we're genetically bred to be hopeful. And what I mean by that is that people long ago who were in trouble but gave up died, and so did their genes. And the result is people who give up tend to disappear from the gene pool, their genes disappear, and people who are hopeful and hang in there, their genes survive and they make up a bigger percentage of the gene pool. You had a much better chance of surviving and passing your genes on to future generations if you were hopeful and you never gave up. If you exit with a loss, you're a quitter, and nobody likes a quitter. And beginners refuse to give up, and therefore they'll often add to the trade, even though at some point it's clear the trade is no longer valid. Once you know the trade is no longer valid, you have to get out. You cannot be adding on hoping that you're going to be able to make a profit or avoid a loss. There's also a social stigma against quitting, so it's bad not to keep trying. Only lazy cowards give up. However, experienced traders know that it's better to be a live coward than a dead hero. The goal is to fight for money, not for principles. When a person starts out, he has a small account, he worked really hard to get the account, and he has the dream of becoming a successful, profitable trader. The money in his account is symbolic. It's symbolic of the birth of his new life as a trader. And his greatest fear is an early death. He focuses entirely on risk. He does not want to lose money because if he loses his account, he loses his dream of being a profitable trader. He focuses on risk. The trader's equation has three variables: risk, reward, and probability. And you have to be thinking about all three whenever you are structuring a trade, and then once you're in a trade and you're managing a trade. Risk is the distance to your stop. Reward is the distance to the target that you're hoping to achieve. And probability is the odds of making money before your stop is hit. Avoiding risk, focusing on one variable, is not a profitable strategy. You always have to be considering all three variables. You'll sometimes hear traders talk about a blown account. A blown account does not mean the account went to zero or went below zero. It simply means that the value of the account fell below the broker's minimum level for trading. If your account does not have a certain number of dollars in it, the broker will not let you trade. One of the problems of only focusing on risk is you assume it's the only danger. Risk implies danger, but it's not. You also have to consider reward and probability, and you need to think about all three when you're structuring a trade. You need to take profits that are big enough to make the trader's equation positive. If you take a trade that has low risk, you have a low probability of making money. That means you have a high probability of losing money. And if you're only taking low probability trades, you must hold for big profits because you need those few winners to overcome all of those losses. And if you don't get an occasional very big winner, your account is slowly going to disappear. There's only one thing that you can do to consistently make money, and that's do the hard work of learning how to trade. There are no magical candlestick patterns. Nothing is easy. You're competing against the smartest people in the world. If something was easy, everyone would be doing it. Every trade needs someone to do the opposite. There would not be enough smart people willing to do the opposite. Therefore, you're looking for an edge, a slight mathematical advantage that will allow you to consistently make money. And because the edge always has to be slight, you're trying to take money from very smart people, you have to be consistently good. You cannot blame anyone else for your mistakes. You have to assume responsibility for your mistakes. At the same time, you should never be hard on yourself after making mistakes or after losing money, because everyone is going to have losing trades. And if you keep focusing on what took place 5 minutes ago, 5 days ago, you're not focusing on what you should be doing right now at the moment. Great traders make mistakes. Great traders have losing trades. The difference between a great trader and a beginner is that the great trader is quick to see his mistake and he gets out. When he knows he's wrong, he just gets out. He doesn't care if it's a loss. He knows he's wrong. He has to get out. And that's what you should do when you make a mistake. As soon as you decide that, yeah, maybe this isn't working out the way I thought it should, just get out, take the loss, and move on to the next trade. Fear of death or the fear of death of your account is a tremendous motivating factor, and it will make traders do just about anything to avoid it. One of the first things traders do when they start out is they look for some kind of protector, like a trading guard or a guru or some expert who will help him. They'll turn on television and take trades that somebody on television mentions. And that's just dumb. TV, internet, magazines, they're filled with trading advice, and it's useless, right? As a trader, you eat what you kill. That means you have to make the money yourself, and nobody else is going to help you. Just because somebody on television says, oh, this is a buy, does not mean you make money. Not only do you have to buy to make money, you have to manage the trade. And as it unfolds, you get more information, and that makes you adjust your management decisions. The guy on television is not telling you what to do after you're in the trade. A lot of times, as soon as you get in, you decide it's a bad trade. Also, sometimes he'll say on television, it's a buy, and then tomorrow, some overnight event will have happened either with your stock or with the market that makes it a terrible buy. He's not there to help you. You have to make the decisions yourself, and you have to learn how to make the decisions. Sometimes your decisions are going to be wrong. Just get out. As soon as you think you're wrong, as soon as you think your premise is no longer valid, get out. That guy on television, you're asking him to give you a fish so that you can eat. That's not how it works. Hoping that someone gives you a fish is not a plan for survival. Learning how to fish is. You have to spend time to learn how to trade. However, once you become successful, life can become magical. I've heard from many, many traders over the years who were losing money for protracted periods of time, and then they finally became successful. The amount of money that they made was astonishing. They couldn't believe how much money they were making. I've talked many times about how beginners focus on risk and how they want minimum risk because they're afraid of losing their entire account. However, because of the trader's equation, you know that if there's small risk, then the risk reward is fantastic. You're risking very little money and you're hoping for a great reward. You also know that whenever there's fantastic risk reward, the probability is low. Chances are you're going to lose most of the time. It is impossible to have a small risk of making a reasonable profit and having a high probability of achieving that goal. It just cannot happen because everyone would take the trade and there would be no one left to take the opposite side of the trade. If you're getting fantastic risk reward, the institution taking the opposite side of the trade has a high probability of making money. You have a low probability of making money, and that means you're going to lose most of the time. Let's say you see a wedge bottom and a bear trend and a decent reversal up, and now you see a higher low. Is it reasonable to buy here? Yeah, it's probably better to take a second entry buy after 3 bear bars, but it's reasonable. A beginner, he's going to put his stop below his buy signal bar, thinking that, oh my gosh, I don't want to lose any money. If I'm going to lose, I don't want to lose much. This is my signal bar. I'll place my stop just below my buy signal bar. Therefore, my risk is very small. Whenever you have small risk, the probability is high you're going to get stopped out. That is just a fact because you cannot have small risk of making a reasonable reward. In this case, you're hoping for a big reward. You cannot have a fantastic risk-reward situation and a good probability of achieving your goal. The probability is always going to be low, and that means chances are if you buy above this bar and put a stop below that bar, the odds are high you're going to get stopped out. If you're taking low probability trades like this, you're going to bleed to death from 1,000 paper cuts. Think about this for a second. Let's say you win 10% of the time. When you do win, you win 20 times bigger than your loss. Well, that's mathematically acceptable. But the problem is if you take 10 trades like that and you get one winner, you have to manage that trade perfectly to make up for the 9 losers. And that's unrealistic. An expert trader might take this buy. He certainly would take this buy. In either case, he would put his stop here, below the bottom of the wedge, below the bottom of the reversal. He's risking more, but he's also giving himself much higher probability of making money. He's allowing for the possibility that the market might pull back and maybe even pull back more before it goes up. All he knows is he thinks it's going up, and he knows if it goes below the bottom of this bull reversal, then his premise is probably wrong and he wants to get out. Here, he could take profits at the end of the session. He bought here, he did not get out, he relied on a stop, and he ended up making many times more than his actual risk. His actual risk was from his entry price above this bar, right here, to just below the low of this bar. His actual risk is small compared to his reward. The beginner who bought here and put a stop here is risking very little. It's far easier to make money if he trades small and uses a reasonable stop, even if the stop is far away and the risk is relatively big. Much easier to make money. Use the appropriate stop and trade as small as you need to trade so that you don't worry about the amount of money you'll lose if your stop is hit. If the amount of money is too big, don't take the trade. If your stop is too far away for you to be comfortable losing that amount of money, do not take the trade. Wait for a trade that's in your comfort zone. Low risk trading is very low probability trading, and that is a losing strategy. Again, you have to manage those rare wins perfectly to make money, or you have to be correct 70% of the time. If you're taking a low risk trade, the only way you can make money is be right a very high percentage of the time. As a beginner, that's just not going to happen. Since a beginner cannot manage perfectly, and since he's not going to be right 70, 80, or 90% of the time, he should not be taking low risk trades. He cannot make the trader's equation positive, and with a negative trader's equation, by definition, it's a losing strategy. Experienced scalpers sometimes will use tight stops, and that's because they know where a high probability trade is and they know how to structure a high probability trade. A really good scalper, he's going to make money 80 or 90% of the time with his trades, and that's absolutely impossible for beginners. It's actually absolutely impossible for most really experienced traders. There are very few experienced, very profitable scalpers, and part of the problem is, first, it's hard to do, and the other is it has to suit your personality, and most traders would not be comfortable with that style of trading. The math is better in this case. Buying here, we have a higher low major trend reversal, 2 or 3 legs down, 1 pullback, 2 pullback 3, or high 2, high 1, high 2, and a higher low major trend reversal with a good looking buy signal bar. In this particular case, you have a good looking buy signal bar, you have a wedge bull flag, small bull trend, bull flag, higher low major trend reversal. It's reasonable to buy above this bar and put a stop here, or you could still put your stop down here. However, if this trade is good, after 3 attempts down, 1 pullback, 2 pullback 3, if it goes above this bull bar, it should not go below the low of that bull bar if the trade is good. If it goes below the low of this bar, the trade is probably not good. This is an example of when you can use a tight stop. In this video, I talked about some rules for avoiding big losses. One of the most important rules is you always have to have a stop in the market, not in your head. Another is, if you think your trade is unfolding different from what you were expecting, get out. If you think you're clearly wrong, get out. Just take the loss and don't worry about it. And finally, avoid low-risk trades. Use the appropriate stop. If the stop would result in a loss that is beyond your comfort level, do not take the trade. Just wait for a trade that would allow you to use a smaller stop. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on losing because of mistakes. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on losing because of mistakes. A common problem with beginners is they do not use the correct stop. They tend to use a stop that is too tight. Also, scaling in is a dangerous thing to do, especially as a beginner. It can lead to very big losses. Beginners, when they do scale in, they don't realize how small they have to trade. And invariably, they trade too large a position and they can't handle the stress of the market going against them. And they end up exiting an otherwise good trade far too early with a loss instead of holding and making a profit. When you're trading, the appropriate stop is usually pretty obvious. If you look at the chart and you know where the stop is, but it's too far away, either you have to trade very small or do not take the trade. It's perfectly reasonable to not take trades. If for any reason you cannot take the trade, if the stop is too far, if emotionally you're distracted, you simply don't take the trade. There'll be plenty of other trades. If you are in a position in your swing trading, you hold on to the position until there's a clear opposite signal or some other strong reason to get out of the trade. you rely on your stop. And you can trail your stop when the market goes your way. It's always good to take partial profits at support and resistance targets. Also, you should get out of the trade if there's a reasonable signal in the opposite direction. For example, let's say you sold anywhere in this box. The stop is obvious. It's at the top of the bear swing. It doesn't matter if you sold here or if you sold here. The stop is right there. Here we have a couple bear bars, good-sized bars, a breakout bar, follow-through bar. The market should not get above this high if it's in a bear trend, and therefore it's reasonable to tighten your stop here. This is still the major lower high, but it is reasonable to tighten your stop here. If the market pulls back, goes above it, and you get stopped out, you can always sell again. At this point, we have 3 legs down, and therefore a wedge, and we have a micro double bottom. We went up on this bar and down on this bar. If we go above the high of this bar, then we have a micro double bottom and a wedge. The channel down is tight. The reversal is probably minor, which means either a trading range or a bear flag, but it's okay to get out here, especially if you sold up here. You have a reasonable profit. You have a reasonable excuse to get out. You can also take partial profits and hold on to the remainder of your position. If you're in a swing trade, you need a swing stop. If the trade looks bad, either get out or rely on your stop. Beginners are always afraid to take losses because they focus on losses and they're worried about being a loser. All beginners are losers, and it hurts. Emotionally, it hurts to take losses. And therefore, beginners hate taking losses, and they often do not take losses when they should. Let's say a beginner buys this reversal up, hoping that the leg up is strong enough to have a second leg up. So he buys looking for possibly a swing up. If he takes the buy, his stop is down here. He has a wedge bottom, a couple good bull bars, he might get a second leg up. Here he has a small higher low major trend reversal, but at this point he does not know that. All he knows is a wedge bottom, the market's starting to get flat, the trend is getting less steep, and he has a decent reversal up. If he buys here and then he sees this bear bar and another bear bar, a lot of times the beginner will get afraid because he'll think, uh-oh, maybe this is a bear flag and the market is simply going to continue down. And let's say he's debating what to do in here and he's not fast enough to put his stop below this low. Then what does he do? He has a swing stop down here. It's reasonable to rely on it. This is a problem that a beginner often faces, and he looks for a compromise. He realizes that he could have gotten out early. He bought this close, a disappointment bar. He could have gotten out around break even here, and he chose to take a chance that maybe it'll go up. Instead, it starts to go down. He chooses not to use a tight stop because he does not want to take a loss. He's thinking that, well, I don't want to rely on the swing stop either because the loss will be too big. Even though, when he put the trade on, he decided this was an acceptable size loss. And therefore, he'll look for something in between. He did not take the early loss. He's afraid to take the full loss, even though it's still not too big of a loss. So he looks for some other place to put a stop in between. He says, well, this is a bull bar, it's a breakout bar. Maybe I'll put my stop below the low of this bar. And that's a mistake. We're in a tight bull channel here. There's no reason to get out below the low of this bar. Either you get out early or you rely on your stop. And what happens is the beginner gets stopped out. He sees this big bear bar and he panics. He's happy to get out. He's relieved to get out, and he's unable to buy again above this bull bar. He misses the big trend that he was anticipating when he bought originally. This is what I call a skunk stop. It's in between two reasonable stops. A skunk in the middle of the road is going to get killed. And if you start using skunk stops between two reasonable stops, your account is going to get killed. The minimum profit that you need to trade based upon the trader's equation is at least 2 times your actual risk, and that has to be at least a minimum scalp size. Minimum is rarely ever the best thing to choose in life. Having a goal of making the minimum wage is rarely ever a good choice, and going for minimum profits when trading is rarely ever a good choice. If a trader buys anywhere in this green box, he knows his stop goes here. If he gets stopped out and it reverses again, he can always buy again. Here we have 4 consecutive bull bars. We have a breakout bar, a bigger bull bar, and a follow-through bar, and we're breaking above this lower high. Reasonably strong breakout to a new high. It's reasonable to trail your stop up from this low to below this low. Getting late in the session, we have a bear bar after a buy climax bar, around a 50% pullback, 3 pushes up, 1, 2, 3, nested 3 pushes up, 1, 2, 3, reasonable to take profits here below that bear bar. Nested wedge and around a measured move target. We have a gap between this breakout point and this pullback, and the measured move projection is right there. Lots of good reasons to exit here at the end of the session. Let's say you look at this sell-off, 8 bear bars, and you think it's a bad buy setup, so you sell at the high of this bar and you get filled right here. It doesn't matter where you sold, your stop is above the top of the bear leg. If this stop is 3 times bigger than your usual stop, then you have to trade 1/3 your usual size. If you cannot do that, then don't take the trade. If a beginner is afraid that his stop is too far and he's worried about his loss, he'll make bad decisions and he should not take the trade. For a trader to become consistently profitable, he has to consistently make good decisions. The beginner, if he took this short, which is a reasonable thing to do, we have a give up bar, we have a follow through bar, we could be getting a spike and channel down. He might be panicked by this bull bar and get out above its high instead of relying on a stop. However, after 8 bear bars, the first reversal up is probably minor, and the best the bulls probably will get is the trading range, and the bears will probably still get at least a small second leg down. Now, why would the beginner get out above this bar? Because he lied to himself. He said he was going to rely on a stop, but he had no intention of relying on that stop. He was afraid of too big of a loss. He was never willing to risk that much money, and as soon as the market went against him, he got out. He sold hoping the market would go immediately his way. That was his plan, even though he told himself his plan was he was going to rely on a stop. Alternatively, if he held, he was so afraid of this bear bar, now he's thinking this might be a climactic end of the move, he'll scalp out for a minimum scalp. Beginners do that all the time. They're in a good swing trade, and they're so happy to have any profit because they've lost so many times in the past few days that they'll grab a minimum scalp. Very often, it'll be a positive trader's equation, so mathematically, it's an acceptable thing to do. However, it's rarely a good thing to do because you're going to make mistakes in life, and you need occasional swing trades to offset all of your little mistakes. If the beginner is really worried about losing too much money, he simply has to trade small. I talk about the I don't care size. You trade so small that you really don't care if your stop gets hit. That way there, you'll focus on doing what is right. Traders need experience doing what is right and not simply focusing in on risk. The trader's equation has 3 variables. Beginners always focus on risk. They ignore probability and they ignore reward. This trade is a good trade for a swing, and it has a potential for a big reward. If you trade small, you're not going to get rich. However, you can practice doing the right thing. And once you get experience doing the right thing and you consistently do the right thing, then you can start trading bigger. And eventually, you'll have a decent shot at becoming rich. Also, you do not have to trade big volume to get rich or make a very good living. I've known traders over the years who trade relatively small position sizes, but they trade extremely well and they make a lot of money. I've heard from many traders over the years that they're surprised by how much money they're making simply by doing the right thing. Scaling in is for experienced traders. It's very easy for beginners to lose far more than they ever imagined if they're scaling in incorrectly. The purpose of scaling into a trade is to increase your probability. Whenever you improve your probability, you always weaken your risk-reward situation. Typically, you're increasing your risk. One of the biggest mistakes that beginners make is they scale in without greatly reducing their position size. They end up losing far more than they ever dreamed possible. And part of that is because they never dreamed that the market would go against them and hit their stop. Only experienced traders should scale in, because an experienced trader will know if his trade is still valid, and if he thinks it's no longer valid, he's not going to scale in. He's just going to get out and take a loss. A beginner will not admit that his premise is no longer valid, and he'll keep scaling in, hoping that the market again goes his way, and he ends up taking frequent big losses. It's a terrible combination to be scaling in and being hopeful. You need to be objective. One big loss can easily wipe out 10 or 20 good trades, and it will take 10 or 20 other good trades to make up for that one big loss. Everybody knows that you scale in to increase the probability of making money. However, beginners think that they can scale in. Invariably, they have an unrealistic plan. They're not willing to take the loss because the position size is going to be too big when they enter their position and they start seeing how fast their losses are growing. Even if the trade is still valid, they'll be shocked by how fast the losses are growing because their position size is too big. We have a bear trend, a bull breakout, a higher low, major trend reversal, and now we have 4 bull bars with increasing body sizes. The market's accelerating up. Therefore, it probably will go higher. Bulls will buy thinking that either the market goes up and they make a profit, or this is a bull leg in what will become a trading range, and they can buy more lower, expecting it to come back up here, and then they can make a profit on their lower entry and get out break even on their first entry. By the closed bull trend, we have a 6-bar bull microchannel, no bear bars in 6 bars. Yes, we're still below a prior high, so this might be a bull leg in a trading range, but it's a reasonable buy. It's a strong enough rally so that the odds are bulls will buy the first reversal down. However, remember, at this point, you don't know if this is the start of a bull trend or if it's a test of the top of the trading range, and it could be followed by a deep pullback to below the bottom of this buy climax, the breakout, but above the bottom of the bull trend. A lot of the bears see the 6 bars up and the 4 good bull bars and look at that and see a lot of momentum, and they wait for a second entry short. In other words, they'll wait for a micro double top or a wedge top before looking to sell. When you look at this, where should you put your stop? You see 2 obvious choices: the bottom of the breakout down here or the bottom of the bull trend down here. Both are reasonable. If you use the tighter stop, you're going to get stopped out more often but lose less. If you use the wider stop, you'll get stopped out less often, but when you lose, you'll lose more. If you take the tight stop in 10 trades like this, and somebody else takes the wide stop, after 10 trades, you'll have about the same amount of money. Both are reasonable, and therefore you can use either one. If it goes down below this low and reverses up, you can always get stopped out and buy on the reversal up. Let's say a trader is willing to scale in 2 more times for a total of 3 entries. Therefore, you have to make each entry about 1/3 of your normal position size if you're using this stop or this stop, whatever your position size is for either of these stops. If you're thinking about you might scale in if this sells off and becomes a trading range, you have to trade extremely small. Beginners can't do that. Either their account size is small and their position size is small already, and they cannot reduce their position to 1/3 size, or they simply think the position size then would be so tiny that it's not worth taking the trade. The result is the beginner ends up taking too big of a trade, and he doesn't realize how bad he'll feel emotionally if it's starting to go against him and he adds on to his position and the rate of his losses accelerates. If your stop is twice your normal stop and you're thinking of entering 2 more times, in other words, tripling the size of your position, then you have to trade 1/6 of your normal size. And if you cannot do that, you don't take the trade or you use a different plan. For example, don't scale in. What you could do is you could buy here, wait for a pullback, and then buy more above a reversal bar. That's a common approach. One concern that you have to have when you're in a possible trading range is a second leg trap. Sometimes you'll get a weak first leg and then a very strong second leg, but it's not breaking far above all the bars to the left. Therefore, it could be a bull leg in a trading range instead of a measuring gap leading to a new bull trend. Beginners only see the 6 bars up and they think that it's going to be a successful breakout. The bull bodies are good, but they're not particularly big and they have tails on top. So this is not all that strong. And look at all of these bars. Every bar has tails. That means this might be part of a trading range. If you have a lot of bars with tails, that is trading range price action, and a rally like this could be simply a bull leg in a trading range. Beginners only see this, big bull bars, and they think bull trend. And they don't see this. We're not above the top of the bars to the left, and this could simply be a buy vacuum test of the top of a trading range. And then you get this. Let's say you buy that close and you see this bear bar. It's 2 legs up. We're still below the bars to the left, the top of the bars to the left. This could be a second leg trap in a trading range. Most traders, if they have a strong breakout like this and a possible trading range, and they see a bear bar closing on its low like that, it's better just to get out below the low of that bar. Because if this is a second leg trap, we could sell off very deeply in the trading range before we get a leg back up. If you do hold long and plan to scale in, you either rely on your stop here or on your stop here. If you get that bear bar and then it trades below that bar, I would not be scaling in at a fixed number of points or pips below. I would wait until we get a reversal up and then buy more above the bull bar, assuming I did not get out below that bear bar. I typically get out below that bear bar. A failed breakout, 2 legs up, still below the top of the bars to the left, still in a trading range, or possibly even a broad bear channel. We have a lower high. When you look at this, you say, well, it's got to go up. No, it doesn't. There's always a reason to take the opposite side of the trade. The bears think this is just 2 legs up and a broad bear channel, and that we'll get a lower high and then a new low. It's reasonable to think that. And then after this bear bar closes on its low, it's reasonable to sell below this bar, betting on 2 legs up in either a trading range or a broad bear channel. It's a reasonable short. Strong enough rally so that the first leg down probably will be bought. But if this whole thing is a leg in a trading range, that first leg down could be very deep and it could even fall below the bottom of this breakout. This is a reasonable buy the close bar. That means that we should get back here within the next 10, 20, maybe even 30 bars, but we should get back here. This is a disappointment bar. This is a disappointment as well. A lot of the bulls who bought here are hoping it comes back to this close so they can get out break even. Otherwise, if it keeps going down, they're trapped. Experienced bulls will get out below that bear bar or on the second or third consecutive bear close if there are 3 bear closes, or they'll rely on their stop here or here and look to buy more lower. This is a breakout above this high. but it's not a breakout above the top of the trading range. Second leg traps trap traders into buying high, trap traders into thinking that this is the start of a trend. That's the whole idea of it. But unless the breakout is far above all the bars to the left, you have to be thinking that it could be a second leg trap, trapping beginners into buying momentum that has not yet broken above all the bars to the left. It could simply be a test of the top of the trading range. Bull breakout above this high, but terrible follow through, and therefore traders should conclude it's still in a trading range. For the moment, although this could be the start of a bull trend, it's also a bull leg and a trading range, or a bull leg and a broad bear channel. It's still below this high. I think it's reasonable to get out below that bear bar. You do not want to see a breakout and then have the follow-through bar be a bear bar closing on its low. It's usually better just to get out below that low. If we go sideways here, you can always buy on a reversal back up. But too much risk that this is a bull leg and a trading range and that we might test all the way down to the bottom of the range. Some traders exit below the first bear bar, others exit below the second, others exit if we get 3 consecutive bear closes. Beginners, all they see is momentum up. All they see is a bull argument. They're not thinking about the possibility that this is a bull trap. A lot of beginners will think, okay, I'll buy. I want to increase my chances of winning. I know the size of minimum scalp. I'll add on the size of a minimum scalp here, and then 2 times the size of a minimum scalp here. I'll get out break even if it gets back to my original entry price. The beginner does not see the opposite argument. He only sees the momentum. But momentum alone is not enough reason to buy. Has the breakout broken above all the bars to the left, in which case maybe it is a bull trend? Or is this possibly a bull leg in a trading range? Momentum up is good. At the close of this bar, there's a 60% chance we're going higher. At the close of this bar, there's a 50% chance we're going higher and 50% chance second leg trap. And as you start to get more and more bear bars, the probability is we're going to get lower. The bears who take this sell have maybe a 40% chance of a swing down, but their risk is small and the reward is at least twice as big as their risk, so it's reasonable for them to take that short. And this is what we got. A huge stop run below the higher low. Yet, look at the follow through after this big bear bar. It's breaking below an important low, but look at the follow through. It's the opposite of this. Strong rally, bear bar, strong sell off, bull bar, terrible follow through, we got a reversal. An experienced trader who took this buy would not buy more below that bear bar or below this bear bar. He would wait until there's a bull bar and then buy more here, knowing that buy the close bulls were reasonable to buy this close. And if you do something reasonable and trade appropriately, scale in appropriately, 90% of the time you can either avoid a loss or make a profit. Experienced traders, if they bought this close and did not exit here, would buy more above a good bull bar here, and then wait for the market to get back to their original close, get out break even at that close, and then with a profit here. You can see the selling that took place here. A lot of that selling is from bulls getting out of their original position, and the smart ones bought more here, and they ended up getting a profit on their second entry. If you get stopped out, let's say you use the tighter stop and you get stopped out, you simply buy again above this bull bar. It's hard to do. It's hard to get stopped out with a big loss and then go right back in and buy. But if you're thinking about scaling in when you put on that trade, if you get stopped out, you buy a double position here, which is what you would have had if you bought here, relied on this stop, and then bought more above this bull bar. Bulls betting that this is not a higher low major trend reversal anymore, but maybe this is a higher low major trend reversal. It sounds easy, but difficult to do, and therefore beginners should not be doing this. Experienced traders can sit calmly and do the right thing, but beginners will not. They'll panic and take losses all day long. This blue box 5-minute chart is the same as this blue box 1-minute chart. Another mistake that beginners make is they'll put a trade on using one time frame, and then because they're afraid of loss, they'll exit using a stop based upon a smaller time frame. Sell the close bear trend. Therefore, traders are selling any of these closes. Nobody's going to sell all of them, but a good trader is going to try to sell at least one or two of them. On the 1 minute chart, it's a very tight bear channel. And these are the entries from the 5 minute chart. That's this entry, and then this is the next one. These are where you'd be getting in if you were selling closes on the 5 minute chart. If you're taking a trade on the 5 minute chart, don't exit on the 1 minute chart. The profits on the 1 minute chart will be too small to offset the losses. This is where you'd exit on the 5 minute chart. It's a sell the close bear trend, so you're looking to exit above a bull bar, or 4 or 5 ticks or 4 or 5 pips above any bar. This is a bull bar, reasonable to get out above that high. If you took any of these sells, this is where you'd get out, and you'd end up with a good profit. Beginners who took any of these sells are probably scared that it's falling quickly and it may reverse up quickly, and they'll be happy to have any profit. The beginner who took this sell on the 5 minute chart, which is right here, if he looks at the 1 minute chart and he sees this bull bar, he'll very often panic, thinking it's a reversal, ignoring 7 or 8 or 9 consecutive bear bars, and he'll get out there. If he sold here, he gets out with a loss. If he sold here, he gets out with very little profit, and he misses a huge profit. If he took this trade on the 5 minute chart, he needs to manage it on the 5 minute chart. He cannot switch to the 1 minute chart and get out on a 1 minute reversal, which is a common occurrence if you're in a good trend on the 5 minute chart. The 1 minute chart is always going to be reversing. It's really important to use the correct stop, and the correct stop is usually obvious. And if the correct stop is far, you have to trade small. If the stop is so far that your risk is bigger than on other trades, simply do not take the trade. Scaling in only for experts. Beginners scale in to increase probability, but they don't realize how greatly it increases their risk until they're in the trade and it starts to go against them and they add on to a losing trade. Beginners should never scale in. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on losing because of mistakes. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on losing when a good trade goes bad. I want to begin by talking about some rules that traders can use to help avoid big losses. And I also want to make the obvious point that all trends eventually disappoint traders, and therefore you have to make decisions when you do see some disappointment. Every trader sometimes makes mistakes, and I talk about losses that are due to mistakes in the videos on losing because of mistakes. For example, let's say a beginner saw this as a double top and he sold on a stop below this bar. He got filled right here. Despite 6 bull bars in the past 8 bars, he still took the short. And the sell signal bar had a bull body closing above its midpoint. That is a mistake to take that short. Most losing trades, even for experts, are due to mistakes and not bad luck. Every trade has a probability that you're going to win and a probability that you're going to lose. And therefore, even experienced traders are going to lose simply because of luck. A big difference between an expert and a beginner is that an expert tends to get out very quickly when he makes a mistake. He loses less. He's not emotionally attached to a position. He doesn't feel a need to prove that he's right. For example, holding on to a bad trade, hoping that eventually he'll be proven right. If he's wrong, he gets out. I want to talk in this video about market risk and how to minimize it or how to avoid it. That's risk beyond your personal control. Personal risk, that means you made mistakes. Market risk is things that you cannot control. The market is doing something that you thought was not likely. It's fairly common that you'll take a trade where the entry is good, the logic is good, but the market does not do what you think was most likely. That's bad luck instead of a bad trade. It's a good trade that went bad. For example, we have a sell to close market down here. Traders are selling closes, selling closes, selling closes. He knows that eventually one is going to be the final one and that the market will reverse and he'll lose money. Nobody's going to sell all of these closes, but traders will sell at least one. And let's say you sold this one and then immediately you see a bull bar and then 3 other bull bars. At that point, the trade is no longer a sell to close bear trend and you have to change how you're trading. One thing you might do is sell more higher and then try to get out break even on your first entry and then with the profit on your higher entry. You need some rules to prevent bad trades from becoming very big losses. When the market is swing trading, it's fairly easy to make money trading in the direction of the trend. Market's going up, you buy. Market's going down, you sell. As long as it's continuing to trend, it's okay to hold on to your position or to enter at any time in the direction of the trend, buying here or selling here. If you're long, there are 3 ways to protect yourself. First of all, you always need a protective stop. After every strong breakout to a new high, you can trail your stop to the most recent major high or low. Here, a breakout to a new high, you can trail your stop to below this low. If the stop is far away, you have to reduce your position size, or if you're entering at a time when the stop is going to be very far away, you simply have to trade small. Anytime there's a reasonable opposite signal, it does not have to be a perfect signal. As long as it's reasonable for you to get out of your trade. For example, we have a slight higher high, we have a bull trend trading range, and a higher high. Therefore, it's a higher high major trend reversal, and it's a wedge rally. We went up here, we went down, up here, and then down, up here, and now we have a bear bar closing on its low. Reasonable to get out of longs if you're still long at this point. You get out on a stop below the low of that bear bar. It's a weak rally, it's a wedge rally, and it's a potential higher high major trend reversal. You got to be thinking that the market is no longer in a bull channel. It's now either in a trading range or in a bear trend. In addition to exiting if there's a reasonable opposite signal or if your stop is hit, you exit if there's a strong opposite breakout. It can be a single big bear bar if you're long, or it could be 3 or more bear bars with moderate sized bodies, especially if they're closing on or near their lows. Here we have 3 bear bars. This one became big, all 3 closing at or near their lows. Reasonable to get out at the market. As soon as you see that third close, you simply exit at the market. You sell out of your long. It doesn't matter if you bought here or if you bought down here. You get out here if you did not already get out. Every channel eventually stops and usually it becomes a trading range. We have a bull channel, it became a trading range. We have a bear channel, and we have a bull breakout, and it became a bull leg in a larger trading range. The single most important rule to protect yourself is having a stop in the market, not a mental stop, not a stop in your head. If the stop is in the market, it's a guarantee that you will lose no more than an acceptable loss. There are often several choices for a reasonable stop. For example, bulls who bought any time in here could have a stop below the bottom of this leg or below the bottom of the bull trend. And bears who sold any time in here, it's reasonable to put their stop above the top of the bear reversal. After every strong breakout to a new high, it's reasonable to trail your stop. If you bought anywhere in here, and then the market breaks out here to a new high, and you have several decent bull bars, it's reasonable to put your stop below this low. And for the bears, you have a strong bear breakout, stop up here, and then once it starts to break out again, you can trail your stop, lower your stop down to the most recent major lower high, which is right here. Put your stop just above. A great scalper can win 90% of the time. That means he's losing 10% of the time. He needs rules to prevent his losses from getting very big. The first obvious one is always have an appropriate stop in the market. For example, let's say you're a scalper and you think we have one push up, down. Maybe the third push will be a wedge and a reversal. The market's transitioning to a trading range. He might sell with a limit order at this high, betting that the third leg up will fail and reverse down enough to make a scalp. Different ways to calculate where to put a stop, but one might be just beyond a measured move up based upon the height of this small, tight trading range. Let's say a trader bought this close, thinking that it's a strong enough pair of bars so that the market will probably have at least one more leg up. Reasonable stop below the 2-bar breakout or below the bottom of the leg. Some scalpers would even put a stop down here or here, thinking that maybe the market will have a deep pullback into a trading range. They can buy more lower, confident that it will come back here after 2 pretty good bull bars. If you're clearly wrong, it's usually better just to exit immediately and don't wait for your stop to be hit. For example, if a bull bought this close and the next bar looked like that, a reversal bar closing near its low, it's a doji bar, but it's also a wedge, 1, 2, 3. If the trader is now concerned that we may get a couple legs sideways to down, and he's a scalper, he's going for a small profit, he does not want to have a big risk. Therefore, it's reasonable for him to get out just below the low of this bar and not wait for his stop to get hit. Anytime there's a reasonable opposite signal, it's reasonable to get out. If the opposite signal does not lead to a reversal and it simply becomes a flag and the trend resumes, you can always get back in. For example, let's say you bought this close, hoping that the bull trend will continue. And then on the next bar, you see that reversal. Yet you want to hold and use a reasonable stop here or here. If you did get out, you could always buy again above a bull bar, especially a second entry buy above a bull bar closing on its high. Reasonable to get out here, a large high 2 rally, 1 pullback 2, nested, there's a smaller one, 1 pullback 2, consecutive tops, we have a wedge top here, maybe a wedge top here, 1 or 1 and then 2, pause and 3, good bear bar. If you get out, again, if the market's still always in long, and it is, you can look to buy again after 2 or 3 legs sideways to down. 1, pullback, 2, pullback, 3, a bull bar, reasonable to buy above this bull bar and put your trade back on. If you get out below here, you buy again above here. If you get out below here, you can buy again above that bull bar. When the market's near the end of the session, you have to be prepared to get out faster because sometimes a reversal may not come back to your entry to let you avoid a loss. We have a bear swing, but a slightly higher low. And then we have a small double bottom, bull bar here, a better bull bar here. And this double bottom is forming a double bottom with this double bottom. So it's a big double bottom with this low and this pair of lows. And it's subdivided into a smaller double bottom. Reasonable to be buying above this bar or buying closes once it becomes a buy the close bull trend. But it's a buy the close bull trend late in the session or late in the day. Whenever that's the case, it's usually good to get out below any bear bar that closes near its low, or 3 or 4 ticks or 3 or 4 pips below any bar, bull bar or bear bar. When you're buying these closes, your stop is here, below the low. And you have to get out, I think, below a bear bar closing below its low, so you can get out here. A lot of bulls will not get out below this bear doji because it has only a small bear body. The odds are it's going to go up a little bit higher. However, once you've had 3 or 4 bars in a buy the close trend at the end of a session or the end of the day, you have to be prepared to get out because usually a buy the close rally at the end of a session will only last 4, 5, or 6 bars. So once you've had 5 or 6 closes in your direction, you have to be prepared for a reversal and therefore be ready to get out. Sometimes there's no good opposite signal to get you out, but you still need some method to get out. For example, one big trend bar is enough to make bears get out before their stop gets hit. Let's say you were using a wide stop up here at the top of this tight bear channel, and you're short for any reason, and then you see a big bull bar like this. This is a surprise bar. A surprise bar has at least a 60 or 70% chance of at least one more leg up and probably some kind of a measured move up. Therefore, once you see this bar, get out at the market. Don't wait for your stop to get hit. If the market is reversing up strongly even here, you're going to get out at the market before a tight stop here is hit. Once you believe your premise is wrong, get out of your position. Don't rely on your stop. If you're short, get out as the big bar is forming, or certainly on the close of the big bar. Whenever you have an exceptional bar like that, there's going to be follow through. So don't rely on your stop. Instead of one big bull bar, if you're short, sometimes you'll see two medium-sized bull bars. In that case, usually it's good to get out on the close of the second bar, which would be right here. This is also 4 bull bars, but 2 of them have pretty good bodies and they're closing on their highs. So reasonable to get out there and don't rely on a stop to be hit. If you had your stop up here, you're not at the stop, but this is strong enough up, we're probably going higher, and therefore your stop is probably going to get hit. And if you're short, it's better just to get out, buy at the market as soon as this bar closes. A lot of traders will simply exit if there are 3 consecutive bull bars and 1 or more of them has a good sized body closing on or near its high. If a trader is short, this is a reasonable place to get out as well. If you're long and you see 3, 4, or 5 small bars, you'll get out on the close of one of the bars, especially if 2 or 3 of them are closing near the low. Bulls who are long here get out on the 3rd or 4th or 5th close. Just sell out of their longs at the market. One big bar against you is a good reason to get out. 2 medium-sized bars against you are reasonable reason to get out. And 3, 4, or 5 small bars against you are reasonable reason to exit. Don't wait for your stop to be hit. Once you've seen 3, 4, or 5 bars against you, if you're long, your stop is going to get hit. So just get out before your stop is hit. Exit on the 3rd or 4th close, especially the 4th close here, a bigger bar. We're starting to accelerate down. And now we're getting a series of bigger bars. This is the bulls giving up. The market's now reversing this rally. So big up, big down, and the bars are getting good bodies. The bulls are giving up, the bears are taking control. The market is probably going to go lower. It's always in short. Every trend eventually ends, and every trend eventually disappoints traders hoping that the trend will continue. Sell the closed bear trend, you get a bull bar closing near its high, you got to get out just above the high of the bull bar. A buy the closed bull trend, disappointed bulls, reasonable to get out here. Sell the closed bear trend, well, not really. But if you're a bear, you're certainly disappointed that the breakout is not bigger, the reversal down is not bigger, and the follow through is not bigger. Buy the closed bull trend, it's disappointing all the way up. We have bars with big tails, small bodies, probably not going to last all that much longer. And then you're certainly going to be disappointed by that big bear bar. Sell the closed bear trend, disappointment bars, bull bars. Buy the closed bull trend, disappointment, bear bars, especially bear bars closing on or near their lows. An attempt at a bear reversal, not convincing, but in any case, if you're a bear, you're disappointed by bull bars. Bull trend, even though it's about 8 bull bars, it's not very strong, and you're certainly going to be concerned by a big bear bar closing near its low. It's disappointing, and it makes you think that the bull trend is ending and the market might be entering a trading range. Usually, a good trader can avoid his loss if he manages his trade well. I talk about this in the videos on entering late in trends, and I'm going to talk a little bit more about it right here. For example, let's say you're treating this like a buy the close bull trend, and you bought one or more of these closes either for a scalp or a swing, and then you see this bear bar. We're in a bull channel. You look to the left, bears who sold this high made money. Bears who sold this high maybe made a little bit of money. Bears were selling above highs all the way up, not making much, but a pretty good pullback here. If we go to a new high, maybe we'll get another pullback. Bears who sold this high made money. They sell that high, they sell more higher, and they get out break even at their first entry and with a profit on their second. Very tight bull channel, probably a minor reversal, meaning either a bull flag or a trading range. However, if you happen to buy that close, you knew that we've pulled back every time we've broken out to a new high. We're in a channel. We're going to pull back soon. If you see this bear bar, you have to be disappointed. You may have bought the high close of the bull trend. More likely, you bought the high close of the current leg in the bull trend. We have 8 consecutive bull bars. First reversal, probably minor, but you have to make decisions on what to do. The easiest approach is to just rely on your stop, and as long as your stop has not been hit and your premise is still good, you can hold on to your position. Strong breakout, new high. This is a major lower high, reasonable to keep your stop right here. If you bought this close after you saw the disappointment bar, you might have placed an order to get out break even, and you were unable. Several bars unable to get out break even. Buying this close was a reasonable thing to do. Usually if you do something reasonable and you rely on your stop and scale in lower, you can avoid a loss and possibly make a profit. One thing to do is rely on your stop, place a limit order to get out break even. Another thing is to buy more, the size of a scalp or 2 to 3 times the size of a scalp below your first entry, rely on your stop, and then get out break even on your first trade and with a profit on your lower trade. We're getting late in the day. A lot of the bulls who did buy here and sat through this are concerned that we might not go much higher. They simply sell out of their longs at their original entry price. Reasonable. Some bulls, as I said, will scale in 1 times or 2 times or 3 times the size of a minimum scalp, rely on their stop, and then look to get out with a profit on their lower entries and get out break even at their first entry. You can only do this if you're trading small enough so that your entire position does not expose you to any more risk using this stop than any other trade. If your position is too big to allow you to scale in and use that stop, don't scale in. Disappointment, you get out break even on your first entry, and if you add it on, you get out with a small profit on your lower entry. Traders scale in for one reason, to increase the probability of a profit or to increase the chance of avoiding a loss. It's a thing that experts do. Beginners should never do it because invariably their position will be too big for the stop that they need. They buy here thinking that they're going to scale in. They scale in thinking that they can hold and rely on the stop. And then they do the math and decide that, wow, I didn't think I was going to be risking that much money. And they end up selling with a loss rather than managing the trade as they originally planned. They had an unreasonable plan given their skill level, their ability to tolerate the market going against them. And the position size was way too big. A lot of bulls who are looking to scale in will only scale in once. They like to wait for a pullback that is at least 2 to 3 times bigger than the minimum scalp size. And a lot of them prefer to buy above a decent bull bar. So for example, a bull might buy here and hope that once it starts to sell off, he gets to buy more, 2 to 3 points or 10 or 20 pips, 30 pips below this first entry, but above a bull bar. For example, this is a good looking bull bar. but it's probably not 2 to 3 times the size of a minimum scalp. If a trader bought here thinking that he's disappointed, he wants to buy more lower, and it does not go low enough, he simply holds on to his position in case it goes lower and then adds on. If instead it does not go low enough to scale in, he simply gets out break even at his original entry. We have a bear breakout, a pullback, and then a strong bear breakout, a pair of bear bars closing below the low, and a follow-through bear bar. A doji, not all that good, but good enough breakout, good enough follow-through, probably at least a little bit more down, and maybe a lot more down. If the bear sells at this close, his stop is above the top of the most recent major lower high, a major lower high. We broke to a new low, and it's a reasonably strong breakout, 4 consecutive bear bars, a good location for the stop. And then he sees this, a micro double bottom, a bull bar, and it's trying to go up. Here we have 5 bars up without a pullback. But is his premise wrong? Is this now always in long, or is it still always in short? This is not enough to make it always in long. This is not enough to make it always in long, and therefore it's always in short still, and has not hit his stop. So it's reasonable to stay short. You sell here and you sit through this because there's no clear, obvious buy setup. This is not a convincing, obvious buy setup. And the reversal never had 3 or 4 strong bull bars. You have 3 bull bars here, not particularly big. If you want, you could get out on the close of this bar. But if you do, the premise is still valid. You look for a bear bar and you get short again below that low. Even though the reversal up lasted about a dozen bars, the market never clearly became always in long, and therefore it's reasonable to rely on your stop, even though the market is now above your entry price. All traders need rules to avoid big losses, and the single most important rule is to rely on a protective stop that's in the market. Every trend eventually ends, and that means how you're trading has to change as well. This is Al Brooks. This is the first of 2 videos on losing when a good trade goes bad. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on losing when a good trade goes bad. Whenever you're trading and your premise changes, you have to change the style that you're trading. Next, I want to talk about how traders can get trapped and the importance of recognizing the trap as soon as possible and then working your way out of the bad trade. The market's in a bear trend. There's a bear breakout, pair of bear bars, decent follow through. However, now the market is starting to go sideways and the pullback is lasting a lot of bars. We have prominent tails, small bars, dojis. The market's starting to enter a tight trading range. It's still always in short, so your premise of a bear trend is still valid. However, if you want, you can exit, for example, on a second leg up above a bull bar, get out here. If you want to be trading always in, you simply look to sell again below a bear bar on a reversal back down. Is this a good trade that has gone bad? Well, it's certainly not behaving the way you want it to behave, but your premise is still valid. It's still a bear trend. It's still always in short. As long as it stays below this stop and does not start to accelerate to the upside, the odds are it'll either go down or down and sideways. This is a big low too short, 2 legs up, 1 pullback 2, a decent sell signal bar. The second leg up had 2 smaller legs, 1 pullback 2, that's good for the bears. You have a sell signal bar closing on its low. Reasonable to go short. If a person got out, this is a reasonable sell setup looking for a second leg down. 1, pullback, and 2. You're getting a second signal. Theoretically, bears who sold here would consider adding on, but usually if they're going to add on to their position, they want the second signal to be the size of a scalp higher or 2 to 3 times the size of a scalp higher. Most traders would not add to a short here, but if they did get out here and they looked at this and saw it as a large low 2 bear flag and the market's still always in short, it's reasonable to sell below the low of that bear bar. At the end of the session, the bulls are getting bull bars here, 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 closing on its high, big bull body, and now we get a micro double bottom with a bull bar closing on its high. Reasonable to get out of your trade right here. The bears have a double top, the bulls have a double bottom. The bulls have a breakout, and they have the minimum follow through that they need. They have the absence of a bear body, a close above the top of the double top. It's always in long. At this point, you know one of two things is likely. Either the market's going to continue higher, bull trend, or you're going to get a deep pullback in a trading range. At this point, the likelihood of a bear trend is small. Because of that, he can buy the close of this bar or the close of the follow-through bar and use an appropriate stop below the bottom of the bull trend, betting that even if we reverse down, it'll be a bear leg in a trading range, and it would be followed by a bull leg in the trading range, and that would get him back to his original entry price, and he could get out break even or with a small loss. If he scaled in lower, he could get out with a profit on his lower entry. He's buying here because he's hoping the market goes straight up. He's confident that if it reverses down, it'll form a higher low and come back to his entry price. Reasonable to take the buy. You have a double top and a double bottom, and the bulls broke above the double top. This high is the neckline of this double bottom. It's the highest price between these two lows. A reasonable buy, close above the high, a second close above the high. Strong reversal down, a pair of decent-sized bear bodies. The bear bodies are increasing in size. A doji, and then a small bear bar, and then a bigger bear body, and then an even bigger bear body closing on its low. But it's still above the stop, and it's not enough to convince traders that the bears have taken control. Remember, the bulls who bought here knew the odds favored either a second leg up or a deep pullback and a trading range, which is what they got. And ultimately, there was a second leg up later in the session. Is it always in short? No. Therefore, the bulls can still stay long and rely on their stop. They can even buy this close, betting that the bear reversal attempt will fail. The sell-off is strong enough so the traders believe at this point that it's no longer going to be a bull trend, that we're probably going to go sideways. When you have 5 bars down and the bear bodies are increasing in size, and the bull trend resumes up, the resumption is usually a minor reversal in a trading range, and it probably will be followed by at least one more leg down. Big up, big down, big confusion, trading range likely. Therefore, traders will change their trading strategy. Instead of buying at any price, including high, betting on higher prices, now they'd rather buy low and sell high. If a trader bought this close and he sees the strong sell-off, he can buy more above a good bull bar, expecting that the sell-off will be a bear leg in a trading range and the market will come back to his original price. He can get out break even on his first entry and with a small profit on his second entry. If the bull who bought here and bought more here was extremely disappointed by this, he might be afraid the market might not rally back to his original price. He might instead try to scale in to avoid a loss. Try to get out at the midpoint between his two buys, here, and here's his average price. He could get out here and avoid a loss. If he exits here, he gets out break even on his first buy and with a profit on his lower buy. Whenever there's a strong reversal down like that right after you buy, it's okay to exit, and then if you do, you can look to buy again if the bull trend resumes. For example, this is 5 bars down. The bear bodies are increasing. The bears have 2 decent-sized bodies. it's reasonable to exit on the close of that bear bar. However, the market's still always in long. There are scale-in bulls who bought here and who are looking for a bull bar, and they'll buy more above the bull bar. If a trader exited here, he could buy again above that bull bar, knowing that a lot of bulls will be buying, looking for a test back up to the high close. The bears who shorted are going to be taking profits. The bulls who bought buy more. The bulls who get out buy more above a bull bar, since it's still always in long. Now we have a double bottom. They could buy here as well. Three consecutive, reasonably strong bear bars, good-sized bodies, two of them closing near their lows, one closing just below the midpoint. It's a possible sell the close bear trend, even though we have not yet closed below all the bars to the left. Some bears will sell that close, hoping that this double top will break below the neckline and fall for at least a measured move down. Reasonable to put your stop above the top of the bear reversal. If a bear who sold that close now sees this big doji bar, he knows the market rallied strongly and came back down here. He might be concerned that he's buying the bottom of a trading range. This reversal up was more than what the bears who sold this close wanted. Some bears, whenever they see a sell the close bar, will place a limit order to sell more 1 or 2 times minimum scalp size higher. For example, right here. If it was a Forex market, this might be 10 pips higher. If it's the E-mini, it might be 1 or 2 points higher. They do that betting that the first reversal up will fail and the market will have to test this close. Some traders will simply place a limit order to sell at the high of the bear bar, betting that it's a bad buy signal bar and therefore more sellers above. A lot of the traders would be concerned that the market rallied that far up after the 3 bear bars and the break below the earlier low. Their premise, therefore, might now be that we're in a trading range or creating a double bottom instead of in a sell the close bear trend. Many of these bears who sold this close will now place a limit order to get out at that close. The market has to go 1 tick below the close for them to get out, which it did. And then you see this strong reversal. The remaining bears are giving up. A give up bar. Chances are we're going at least a little higher. We have a strong reversal down, decent sized bear bars, closing at or near their lows. We have 4 consecutive bear bars. The odds are the first reversal up will be minor, and the best the bulls will get is a trading range. That is what the odds are, but it's not a guarantee. In any case, it's a sell the close bear trend, either starting here or starting here. Doji bar, a lot of bears would not sell this close. They would be concerned that the market might be getting a pullback. But let's say a bear did sell one of those 2 low closes. He's hoping that the market will keep going down. He's confident that if it starts to go up, if he manages his trade correctly, he can avoid a loss. And he might even be able to make a profit. Therefore, the bear might place a limit order to scale in at least the size of a minimum scalp above his first entry, looking to get out break even on his first entry and with a profit on his second. So let's say he sold the size of a scalp above his first entry at this close, and then he places a limit order to get out at this close. To get filled, the market has to fall just below that close. But look what happened. Look at this low, look at that close. It did not fall below that close. What do you think the disappointed bears are going to do? They tried to get out break even and they could not. Now they're concerned that they might be trapped. They might then raise their limit order from this close to a little bit above, maybe a tick or 2 above or a pip or 2 above, hoping to get out with a profit on their second entry and break even on their first. The bears who tried to get out with their limit order did not get filled, and therefore a lot of them will raise their limit order. But look what happened here. the market came down to just above that low, but not down to that low. And chances are the bears who raised their limit order, trying to get out with a small profit here and a small loss here, were unable to get filled. The market rallied again. What's going to happen here? The bears are going to give up. So they gave up here, and other bears gave up here. So if you see sell the close bears unable to get out once, and then if they raise their limit order unable to get out a second time, they're going to give up, and that usually creates a reversal. And therefore, if you're short, for any reason, let's say you sold this close and you have your stop up here, you know that bears are getting trapped. They're unable to get out, and they're unable to get out at an even worse price. They're going to give up. Therefore, if you're still short and you did not get out, you have to get out, for example, above this second bull bar. I'm always paying attention to trap traders, because if there are trap traders, then there's fuel, there's energy for the market to make a move. We know that the bears who sold this close failed to get out here. They were trapped. They raised their limit order, and they're still trapped, still did not get filled. That increases the chances that we're going to get a reversal. Tight bear channel. Even if we do get a reversal, it probably will be minor, which means the best the bulls probably will get is a trading range. And they did. This went above this high, but it still stayed sideways for about 30 or 40 bars. Bears who twice tried to get out without a loss failed, and therefore they should get out, take the loss, rather than risk having it become a big loss. You don't want it to hit the stop. If you know that you're wrong, and the market's telling you that you're wrong to be short, don't wait for your stop to get hit. Simply get out. The bulls see that the bears are trapped, and they expect that the market's going to rally far enough up for them to make at least a scalp, and they're going to buy exactly where the bears are getting out. Some of the bulls place limit orders to buy at this close, expecting that after this bull bar, the bears would try to buy at that close. If the bears are going to buy instead of sell, bulls want to buy as well. So they were buying at that close or just a little bit above, and then after this reversal, they knew the bears would be more scared, and the bulls who were flat would raise their limit order to buy a little bit above that close, just the way the bears did. And then stop order bulls would buy above this pair of bull bars closing on their highs after seeing trapped bears, knowing that the bears would give up and buy back their shorts. Three consecutive bull bars closing above their midpoints near their highs. If you're still short, you have to get out. You cannot wait for your stop to be hit, because your stop is probably going to get hit. Your premise of a strong bear trend is no longer valid. The market is telling you that you're wrong. Whenever you take a reasonable trade and you get an immediate reversal, 90% of the time the market will let you out without a loss if you manage your trade correctly, which means you use an appropriate stop and you scale in. Sometimes you may not be able to get out without a loss for a lot of bars, 10, 20, or 30 bars, and that was the case here. A test of your entry does not mean the market falls below your close. It means that it gets near your close, close enough so that traders start to buy back their shorts if they're short, close enough so bulls will buy, betting that the bears will be trapped. The bears were trapped twice, could not get out here, could not get out even when they raised their limit order. They're trapped into a losing trade. Whenever the bears are trapped and you know they're buying back their shorts, they're not going to be eager to sell again a bar or two later. The odds are you're going to get at least two legs up. The bulls who did not buy know the bears are trapped. They know that the bears will buy back their shorts on any minor reversal down, and the bulls therefore will buy as well. At this point, is it a buy the close bull trend? I would not call it a buy the close bull trend. It's a tight bull channel, but big tail on top and big down, big up, big confusion, probably a trading range. Strong enough rally, first reversal down, probably minor. And that means either a bull flag or a trading range. And therefore, the risk of buying that close is not great. If you manage your trade correctly, you'll either make a profit or you'll avoid a loss. A bull who bought here probably would put a stop all the way down here. Big down, big up, trading range likely. And if you're buying at the top of the range, hoping that the market's entering a bull trend, you need to stop below the bottom of the range. After this big bear bar, these bulls were disappointed. They concluded that instead of the market going straight up, we're probably going sideways. A lot of them simply placed a limit order to get out break even because their premise of a bull trend is wrong. They see that it's wrong. This bear bar tells them that it's wrong. And therefore, it's a trading range, and they're long at the top. They'll try to get out break even at the top because you don't want to be long or holding long or buying at the top of a developing trading range. If the bulls did not take their profit here, they got trapped. You can see how the market immediately reversed down once it got above that close. A lot of the ones who are hoping for a bull trend, after they see this, will place a limit order to get out at that close. And you can see it went just above the close and sold off a second time. That tells you that the bulls do not want to be holding long at this price. And therefore, bulls are not going to be buying here. They're going to be looking to buy lower. The bulls who did not get out here or here will give up and will probably get a couple legs sideways to down. Some will get out below this micro double top, and then we have a pullback with a bear bar closing on its low. Some will get out here. They're doubtful that we're going to go very far up, and therefore the ones who did not get out, some of them will sell out of their longs above this bull bar, trying to minimize their loss. Buy the close bull trend, not all that strong, but certainly reasonable to buy. The bulls who are buying here are hoping the market continues up. They're confident that the rally is strong enough so that even if it reverses down, the reversal will be minor, stay above this low, and it'll be followed by a test back up to this high, maybe a resumption of the bull trend. If you are a buy the close bull and you happen to buy this close, and then you see this bear bar, you're disappointed. A lot of the bulls who buy here will wait to see if we get 3 or 4 bear bars, and then they'll get out at the market. They're confident the reversal is still minor, and they'll look to buy again on a resumption back up, especially above a decent bull bar, like above this bar or above this bar. Reasonable to buy the close. Whenever you have a reasonable buy the close entry, 90% of the time you can manage your trade well enough to either make a profit or avoid a loss. Therefore, the buy the close bulls, they never really had a chance to get out. It never went back above this close. It immediately turned down. Maybe they could have gotten out here. I don't think this bear bar was enough to disappoint a lot of them, so it's reasonable for them to hold long, betting that even if we sell off for 10 or 20 bars, it'll come back up to that close. They're betting that instead of a bear trend after such a strong rally, the first reversal down will be minor and we should get back up to that close again and form a trading range instead of a bear trend. Some computers will read this as a parabolic wedge, 1, 2, 3, 4, or 1, 2, and then 3. And with that, a lot of bulls will get out simply below the bear bar because of a possible parabolic wedge top. But they don't have to. Some will wait until 3 or 4 bear closes and then get out, afraid that we'll have an endless pullback and then a bear breakout. Others say, yeah, it's 3 bars, 4 bear bars, but none of them is very big. Some of them are not closing on their lows. This sell-off looks weaker than this rally. We're probably going to get a higher low and a trading range instead of a bear trend. Let's say you look at this and say, oh, that's a buy the close bull trend, breaking out to a new high of the day. We got 3 consecutive bull bars. And let's say you happen to buy this close. It's not a great buy because we get a large two-legged move, 1 pullback 2, possible tight trading range final flag, and 2 buy climaxes here, pause here. However, it's not unreasonable to take that buy, hoping that we're going to keep going up. Reasonable to put a stop below the bottom of the tight range, below this breakout, below the bottom of this bull swing. All reasonable choices. However, once you conclude that your premise is no longer valid, it's better just to get out instead of letting your stop get hit. This buy the close bar was followed by a big bear bar closing on its low. It's 2 legs up, 1 pullback 2, each subdivided into 2, 1 pullback 2, and then 1 pullback 2. That increases the chances that we're going to get a deeper pullback. With a strong bear bar, it's reasonable to get out below the low of that bear bar and just take a loss. Possible parabolic wedge here, 1, 2, 3, and then a bear bar closing on its low. It is reasonable to get out here. However, the bull's channel is tight. A lot of bulls would like more confirmation that the bears are taking control. They'll wait for 3 or 4 bear bars and then get out. Their loss is still not particularly big, especially if they're looking for a swing up. So some will get out on the second consecutive big bear bar, others will get out on the third. The ones who did not gave up here. You can see this bar is bigger, and it represents the final bulls giving up. The bears, once they see 3 bear bars closing on their lows with reasonable context for the bears, they'll start selling closes. Once they saw this close, a lot of bears sold the market. The remaining bulls sold as well. We have a breakout bar here. Bears are selling exactly where the bulls are getting out, especially by this third close. A lot of bears believe we're going to get at least 2 legs down, and therefore, if we try to resume up, we'll get a lower high and then another leg down. By this third close, the market's always in short. If you're a buy the close bull, you cannot be holding long once you believe the market's always in short. And therefore, you get out exactly where the bears took control, and that's by the close of this third bar. You get out no later than here, and don't wait for your stop to get hit, because the market's always in short. It's probably going lower, and your stop probably will get hit. Maybe this stop will get hit as well, and it did. When the bulls give up, chances are we're going to get a swing down, and at least 2 legs, maybe 10 bars, 2 legs as a minimum goal. If a bull did get out below this bear bar or on the second or third bear close, and there's a good looking buy signal bar, the bulls can always buy back again. If you buy the close and it reverses down strongly, you missed a topping pattern and a sell signal. And even if you do not see the sell signal, you can see that you're clearly wrong and you have to get out. Don't wait and say, oh my gosh, it's reversing down. There has to be some pattern here that I'm not seeing. You don't have to see that. Once you see 3 bear bars closing on their lows, the market's going down. You have to get out of any longs. Whenever you're trading and your premise changes, you have to change what you're doing. If you're buying thinking it's a bull trend and now it's clearly a trading range, you have to modify your style of trading and make it appropriate for a trading range. Trap traders provide fuel for a trade. If bears sell at the bottom and the market's starting to reverse up, the bears are going to be trapped and they have to buy back their shorts. If the bulls buy and the market immediately reverses down, they have to get out as well. For example, if you're long and the bears get 3 consecutive bear bars closing on their lows, don't wait for your stop to get hit. The market has changed what it's doing. Your premise is no longer valid and you have to get out. You just sell out of your long at the market on the close of that third bear bar. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on losing when a good trade goes bad.